Hello and a very warm welcome to Econoday Unplugged on Tuesday, the 8th of August 2023. Terry Sheehan is on the US East Coast, Max Sarto's in British Columbia, Brian Jackson's in Sydney. I'm Jeremy Hawkins here in London. Well, looking around the globe, yield curves are quite steeply inverted in US, Canada and Mexico, as well as in France, Germany, Switzerland and the UK. And indeed, also in New Zealand, Hong Kong and Singapore. And that's just some of the countries currently on the list. Now, in the past, that might have been seen as a precursor of recession. And indeed, despite the various distortions caused by quantitative easing and quantitative tightening, some investors still think that will be the case. However, just last month, the IMF revised up its world economic projections for 2023, and that included stronger outlooks and positive growth for every G7 economy bar Germany. So is there a downturn just around the corner, or can we look forward to something more akin to a soft landing? So time to find out what the Econoday team thinks. So to Terry then. Ms. Sheehan, last Friday, the July employment report showed the US economy adding fewer jobs than expected, but the unemployment rate fell while wage growth picked up. So a mixed outcome, and that following surprisingly strong second quarter GDP. Now, I noticed the latest Bloomberg survey shows a clear majority of investors expecting a US recession before the end of 2024, and around a fifth or so seeing a possible slump in 2023. So bottom line then, what's your outlook?
Well, at least for the near future, the U.S. economy looks to be in pretty good shape. We had solid growth in the second quarter. The very early forecasts for the third quarter, particularly the Atlanta Fed GDP nowcast, is for 4% growth in the third quarter.
As much as 4%?
Yes. Now, this is very early, so I expect that will go lower.
Okay.
But, despite the fact that hiring appears to be slowing, job losses are minimal at this point. It very much, at least for now, looks like the Fed has engineered their soft landing. As Chair Powell mentioned back at his press briefing after the FOMC meeting, the Fed staff is no longer forecasting a recession this year. Now, that doesn't preclude one in 2024. But for the moment, the U.S. economy is showing its fundamentals, and those are for solid consumer spending, pretty good business investment, and this is all happening in a higher interest rate environment. So it seems a little contrary, but
okay,
that seems to be the case.
I guess, yeah, I mean, quite. So let me ask you, why do you think that is? Given what's been a hugely aggressive Fed, well, not just Fed tightening, clearly it's kind of all around a lot big chunks of the world. But why do you think it's the fact that we've seen interest rates go up as far as they have done? And indeed, obviously, we've got the balance sheet adjustment compounding that as well at the moment. And yet this US economy appears, at least at the moment anyway, to be so resilient. What's kind of changed?
Well, probably more than anything, it has to do with the fact that the labor market is strong. A lot of people managed to get solid wage increases, either at their current employment or by switching jobs. And that trend has not yet finished. So I think a lot of it is that U.S. consumers are seeing good spending power, and that's what's keeping things going.
All right. Well, I guess most people would try to interpret something, whatever a soft landing really means, as at least sort of indicative of growth approaching, moving back down to trend, without it generating any real additional inflation problems. Now, we'll get what CPI due out this Thursday, I remember rightly, isn't it, this week?
Correct.
What's going on with inflation? Is it the case, you think, that we can actually get down to, say, growth moderating, but still remaining positive, like the Fed wants, but at the same time, inflation continuing to come down, or are we getting towards the bottom of the current downward trend, you think?
I think we might be getting near the bottom of the current downward trend. More than one analyst has noted that the core inflation the more the interest rates have put downward pressure on prices, the harder it gets to make progress. The other thing is that we're seeing signs of food and energy costs coming back up again. Part of that is the situation in Ukraine. We may not actually be seeing as good of progress on headline inflation as we have been either. So I think what we're going to hear from Fed policymakers is that the situation is fluid and that we can expect more rate hikes.
That's what I was going to ask you. So really pull all this little lot together. And what do you think it means for the September FOMC? Are we in a pause now with the possibility of rates going up, or do you think we've actually reached the top end of the cycle now?
I think September will see another 25 basis points, and I think that will probably be the top end of the cycle.
And how soon, which of course is a follow-up question, do you think rates might actually be coming down?
I think we probably would have to wait at least until the spring of 2024, maybe a little later.
All right, fair enough. And one last other thing I want to ask you. IMF data showed that the US was the largest recipient of inward foreign direct investment in 2021. Now, last week, the US Treasury boosted its quarterly funding for, I think, was it the first time in about 2 years? And at the start of the month, of course, we had the Fitch Ratings Agency unexpectedly cut the US debt rating from AAA to AA+. So, I mean, do you think this could be an issue for US funding going forward, and indeed, or future US policy, and of course, ultimately the US economy itself?
Well, I don't think it had a lot of immediate impact, but it does speak to the contentious political situation here in the US. And I think it's sort of a warning shot that we need to get our political house in order to have our fiscal house in order.
Okay, fair enough. Anything else you'd like to put in the pot then, Terry?
No, we are definitely very much looking at Thursday's Consumer Price Index report. It's probably, we still have one more employment report and one more Consumer Price Index report after that before the next FOMC meeting. But we will be hearing from Chair Powell probably later in the month when he's at the Jackson Hole Forum. So I think we'll be looking for some guidance from him then.
Fair enough. Great. Okay, thanks a lot for that, Terry. Right, Max, then let's move across the border to Canada. Where are we? Middle of July, the Bank of Canada raised rates again by 25 basis points, but said no recession is expected. I say we've got it's fairly strongly inverted yield curve in Canada at the moment. Also said it expects growth to average about 1% through the first half of this year, and I think the first half of next year. So is this a kind of plausible scenario to you? And if anything, where do you see the risks lie, on the upside or the downside?
For Canada, I think risk balance is pretty neutral. I don't see a huge upside or downside right now. And then I think the Bank of Canada forecasts are not outside the range of what private economists are forecasting.
All right, then. Let me ask you about the latest labour market report. We saw employment down, getting on for 6,500, the second fall we've seen in 3 months. We've also seen a very weak Ivy PMI survey. It's down to 48.6 in the same month. So that's its worst, well, certainly significantly worse than market estimates. And I think, was it the first negative reading we've had in about 6 or 7 months or so? So, I mean, do you think there are some tentative signs at least that the economy may be starting to slow a little bit more than the Bank of Canada might be anticipating?
I think this is the beginning of a kind of a hint of bad news that Bank of Canada people really wanted to see for a long time. And jobless rate, of course, 5.5 is much higher than Japan's 2 point something. But I think it's a small economy compared to the U.S. economy when the non-farm payrolls in the U.S. Rose, by a less than expected, but still high. Canada fell, but it can fluctuate from month to month. So I don't think it went beyond the scope of the slowdown that monetary policy people wanted to see.
Okay, let me ask you maybe a slightly off the ball kind of question, but I've seen some people talking or trying to relate what's happening in Canada at the moment to some other recession indicators. In particular, people remember the former Fed US economist Claudia Salm, her recession indicator, which has it that once the 3-month moving average of the unemployment rises half a percentage point or more above its 12-month low, then the economy is contracting. So looking at the Canadian data, we got the 3-month moving average of unemployment now at 5.4%. So that was up from 5.2% in June, but potentially more importantly, if you believe what Ms. Salm said, it's 0.4 percentage points above its 12-month low. So another point on that, and we'd be up to the kind of threshold where she believes that recession is effectively just around the corner. Do you attach any weight to that, or do you think there are other things going on in the labour market at the moment, which means that rising unemployment rate is perhaps giving a slightly wrong impression about just how underlying weakness is at the moment?
I think you just quoted U.S. model, and
it is, yeah, very much so.
Yeah, you could apply largely to the Canadian situation too. But I think BMO's chief economist Doug Porter said the Canadian experience would be more like 0.7 instead of 0.5. But
interesting.
I think the too much focus on the unemployment rate alone would lead us to the wrong direction. And I think as Bank of Canada people are saying too, a wide range of wages and productivity and all these figures they have to closely look at. Okay,
fair enough. Anything else on Canada?
The Prime Minister and his wife announced that they're going to be separated, but I don't think it's making a huge impact on the markets yet.
All right, well, let's move to part of the rest of the countries you cover, in particular Japan. Now, clearly, Japan doesn't have anything like an inverted yield curve at the moment. But I want to ask you about the economic outlook. And I want to ask you about policy. I mean, it's been great fun over the last couple of weeks or so trying to interpret what the Bank of Japan is doing with a tweak of policy that I think most people seem to assume was a nod to higher bond yields, almost immediately followed by intervention of markets to achieve exactly the opposite. So what do you think is actually going on in terms of BOJ policy currently?
Yes, I remember saying during the previous podcast that no drastic change will be made at the July meeting.
You did.
And I think it depends on where you stand, whether you look at it as a really shrewd way of sort of covering up the actual mini hike, or whether if you focus on the overall sort of decision of keeping the main framework of a minus 0.1 on the shorter end and around 0 still, and the officially 0.5 either way. So that means unchanged. But I think Bank of Japan people are buying themselves some time, the safety margin in case there's a spike in yield curves beyond their control, like, maybe what happens to the U.S. Treasury market could spill over to Japan. And the last thing they want to see is something serious happens between the meetings and like in August, and they can't really step in immediately. And, the yen could lose again, which would be politically very unpopular when government is trying to give subsidies to keep the energy bills down.
It's interesting. So it seems it's almost a case of the BOJ trying to introduce some kind of sort of policy creep without actually disturbing the markets. In any case, okay, getting on to the real economy then, we're due the second quarter GDP figures, I think, was it next week, isn't it? So what's expected there, and where do you think growth is going to head from here?
According to my survey of economists, it's going to be 0.9% growth quarter, which would be 3.3 annualized. That will be an acceleration from 0.7 or annualized 2.7 in the first quarter. And that would be actually above 2.4 in the US and 1.5 in the Eurozone. So, at a glance, looks like it's really resilient, but I think the real picture is slower domestic demand, actually negative in the second quarter. Um, the leading leader of the growth would be net exports, which means exports of automobiles have been recovering thanks to eased shortages of semiconductors and supply chain improvements. But the rest of the exports are not that strong, and net exports is going to see a little rebound because import costs are falling fast because of the reverse base year effect. So even though consumer spending is still resilient month to month, but it may be slowing down a little bit. See how things go going forward. The Economy Watchers Index is up again, which means there's still concerns about labor shortages, but as long as government subsidies for traveling continue and people are not too squeezed by the rising prices of food and durable goods, consumer spending may last a little longer than we thought originally.
Okay, and last one from me, I'll ask you about wages. We talked before about, and you in particular discussed just how important wages are to BOJ policy. The figures I saw, I think, was that it came out this morning suggesting that wages actually somewhat surprisingly decelerated in the latest data. Is that a bit of a setback for the Bank of Japan, or is it really just more of a reflection of the kind of the big economic picture that you're talking about, whereby domestic demand may be picking up, but still doing quite slowly?
I think you're talking about nominal real wages, total monthly average cash earnings. If you take a look at the overall, that's actually not too bad. 18 straight month of year-on-year rise, 2.3, slowing from 2.9. But then the key indicator is base wages. That's still okay, 1.4 after 1.7. I think the real problem here is real wages. Let's see, still down 1.6 from a year earlier in June after falling 0.9. So people's wages are not really catching up with the rate of inflation, probably because it's still early for some companies, smaller companies, to actually reflect the results of the negotiations between the big companies and the unions this spring. So see how things go beyond summer bonuses, and the real key is whether Bank of Japan people can see any signs that many companies going to keep raising wages into the next fiscal year starting April, and that sign or first signs may come from executives from Toyota or steel makers at the end of this year or early January, and then it's going to be an interesting time whether the Bank of Japan should consider ending the negative interest rate policy on the short end.
From which I assume you're suggesting then that there's going to be no sort of outright change in the minus 0.1% short-term rate until at least we get into 2024.
That's right, yeah.
Okay. Anything else from Japan?
Nothing so far.
Okay, great. Thank you very much indeed for that, Max. And let's head down south then to Brian and China. Mr. Jackson, positive yield curve there too. In fact, I think it's been the steepest the last couple of years or so. But looking at Econoday's consensus divergence index, that's been pretty well sub-zero, i.e. that means that the economic data are coming in weaker than expected since the start of May time. And clearly investors still very worried about recovery prospects. So what's the outlook for Japan? Well, what's the outlook for the Chinese economy in general, and also in terms of what the policymakers might try to do to compensate for it?
Yeah, I think the data have been coming in a little bit weaker than expected, but not by a great extent. Look, our divergence index has been, slightly below zero, but not to a large extent. So, I think what we're seeing is a little bit of volatility in the data, just because we tend in China to look at the year-over-year numbers rather than sort of the month-over-month or quarter-over-quarter, which aren't always seasonally adjusted or aren't always as heavily focused on as the year-over-year numbers. And of course, that means we are hostage a little bit to base effects and swings, sort of driven by what went on 12 months ago when various public health restrictions were being imposed or lifted or whatever. So I think we sort of need to look a little bit past some of the volatility in the numbers that are being driven by what happened 12 months ago with public health restrictions. But yeah, if you sort of take an overall view, looking at the PMI surveys, looking at the official data that we had almost 4 weeks ago now, we are seeing a bit of a soft patch in the numbers. We had I think a bit of a boost to the economy early on in the year when we did with some public health restrictions, and that momentum seems to have faded in the last couple of months. Certainly, the manufacturing PMIs are showing contraction in that sector. The non-manufacturing PMIs are showing growth, has come off a little bit in the last couple of months. So yeah, we're sort of in a bit of a lull at the moment, and that was something that was addressed by the senior leadership a week or so ago, reported in the official press. They were meeting to discuss the economic conditions and to discuss what that meant for policy going forward. And it was interesting to hear some of the phrases that they used. They described the current recovery as tortuous and wave-like. So I think just acknowledging the some of the volatility that we have seen in the data. But the interesting conclusion from that, though, is that they don't feel they didn't indicate that they feel a great need to adjust policy settings going forward. We've had a few little tweaks in reserve requirements and loan policy rate over the last couple of months, but even that has been sort of identified or characterised more as an adjustment to liquidity conditions rather than a shift in the policy stance. So they are saying at the moment, we want to keep policy pretty stable, and they seem to be hoping that they don't need to do a lot to try and get this recovery back on track.
Okay, actually a couple of things within that. I mean, one from the trade side, the trade numbers you had out, was it this morning or yesterday? Very weak exports. I think they sort of contracted by the most since we've seen the start of the pandemic. Also, imports were down quite sharply as well. Now, last week I thought I saw something to the effect that the Chinese authorities had been asking some local banks to reduce or at least defer some of their dollar buying to ease pressure on the exchange rate. So firstly, do you think the exchange rate might play more of a role in terms of policy going forward? And the other thing, a lot of people seem to be concerned, well, perhaps inevitably, but what's going on in the housing market and how that could dampen down growth over the rest of the year. What do you think is going on with that?
Yeah, I mean, certainly I would sort of say that, again, some of the maybe the large year-on-year numbers in the trade flows might also be sort of base effects from we might have had a bit of a surge in trade flows 12 months earlier when restrictions were lifted. So we just caution sort of paying attention to base effects there. But yeah, certainly the weakness in trade flows is consistent with what we're seeing on the PMI survey data as well. So I think that's certainly true to some extent, that we are seeing a bit of a lull, not only in domestic activity, but also in external demand and trade going forward. And yeah, certainly, the exchange rate is one lever that they can pull. I think they've been reluctant to use that policy tool very aggressively. And that was certainly one of the things that they said in that meeting that was reported in the official press, that they want to keep the exchange rate fairly stable. So I don't think there'll be anything too aggressive there. And again, they're just, I think, hoping that things will just pick up almost independently of them making very big adjustments to policy.
Okay. Sorry.
But the housing market, yes, that's definitely an issue that again was highlighted in that statement that we saw in the official press. they have been tweaking a few things here and there to try and ease the pressure on first home buyers, trying to ease the pressure on financial institutions that we are seeing in parts of the property market, and that probably was also the thinking behind some of those tweaks in the loan policy rate and the loan prime rate and reserve requirements going forward. But again, there doesn't seem to be a lot of appetite for major shifts in the policy settings.
All right, the last one I should, certainly in terms of China anyway, is inflation. Obviously, we get the CPI and the PPI data out, I think, later on this evening, and there seems to be a lot of speculation we'll actually see inflation going negative. So, I mean, are the authorities generally concerned that we could be getting into some, out-and-out deflationary spiral now?
There hasn't been a lot of commentary from that, but of course, they don't always show their hand about what they're thinking about, the specifics of the economic data. So it's hard to get a read on, how they're seeing that. It is striking just how they have avoided or not had the same sort of price pressures that have been evident in other parts of the world, really. So we'll wait for a couple of hours and see what's happening with those inflation numbers. But I think it's generally consistent with the activity data, just showing that we are in a bit of a lull at the moment, and but not a lot of appetite for changing policy settings.
All right, let's move to Australia then. Can't say we got an entirely negative yield curve there, but at least parts of it are negative. In terms of the sort of economic outlook, I think first quarter GDP was up 0.2%, but from what I've seen, retail sales volumes appear to be looking pretty soft. We're down 0.5% in June quarter, so we had 3 consecutive quarters of negative numbers, which, if I've got it right, is the weakest period we've had since the global financial crisis. So is it the case now that high interest rates in Australia, courtesy of all the RBA tightening we've seen today, is starting to have a significant impact on the consumer sector now? And if that is the case, do you think there's a chance we could see recession loom in Australia?
Well, the answer to the first question is yes. I think we're definitely seeing the impact of what you would expect policy tightening to have on the consumer sector, and not only the increases in policy rates, but also just more generally the cost of living pressures that are a huge focus here in Australia at the moment, and you're seeing it in all the media. It's the water cooler discussion, etc., etc. So, I don't think it's a big surprise that we are seeing that showing in the consumer data that are coming through, and that's certainly been the main risk to the outlook that has been highlighted by the RBA in their recent communications. Will we see a recession? Will we see a really serious downturn? It's not. I think it's too early to say that the data is showing that, but it's definitely an obvious risk. And for 6 or even longer than 6 months, I think you've heard language from the RBA in their statement saying that it's a very narrow path that we're trying to tread here. We're trying to get this inflation back down to acceptable levels, but we realise that the risk of doing that is that we're going to not have the nice soft landing that everyone would like to see, and so I think that's still a very real risk, and that is obviously behind the RBA's thinking of pressing pause on the rate hikes that we've seen over the last few months, even though inflation is still way above where they want to be, and even though inflation is still going to take at least another 2 years before it gets back to their target level. If you were just looking at inflation and alone, you would still be going hard on policy tightening. But obviously, they are concerned about the growth outlook, so that is restricting their room to keep on moving on inflation.
Okay. Last one to ask you on Australia is the new monetary policy framework for 2024. I know we touched on it briefly in the previous podcast, but since we're getting closer now, and there have been some more bits and pieces out about it, what in summary form do you think it might mean in terms of any kind of different approach to RBA policy as we go through next year?
I don't think it will really change, the way that they set policy. Well, sorry, the actual policy outcomes, I should say. I don't I don't think that you're going to see a different level of policy rates at the end of 2024 under this system than you would have under the current system.
Right.
You know, they'll continue to analyse economic data in the same way and make, you know, the same judgments, I believe, based on that. It's just, you know, the process is going to be a little bit different. You know, the main headline from the changes is that we're moving from 11 months a year to it'll be 8 meetings. So slightly bigger intervals between meetings, and also a little bit more transparency in terms of what's published and how quickly it's published. And there'll be a press conference after it where the governor will be, you know, have a chance to present and respond to questions. So a little bit of a change in the process and the procedures, but I don't think it signals a change in the actual outcomes or the policy judgments that the RBA are making.
Okay, I should say the inflation target remains unchanged. That's right.
Correct.
Yeah.
Yes.
Okay. Right.
But yeah,
sorry. Yeah.
Just to be, you know, clear, we are getting a new governor as a result of this. The current governor, Philip Lowe, is not having his term renewed, and the deputy governor, Michelle Bullock, will be taking over.
Okay, look forward to that. Right, well then, let's move on to New Zealand. Well, yield curve is strongly inverted with good reason, in the sense that, of course, the New Zealand economy fell into recession in the first quarter of this year. I know we got weather distortions and bits and pieces involved, but looking through the odds and sods, it seems to me that, you know, particularly the labour market, by and large, still seems to be pretty strong, perhaps even strong enough that the economy is still overheating. So, I mean, do you think we've reached the top end of New Zealand interest rates yet? Or, you know, we've got another meeting from the RBNZ next week. Could we even see rates going up again then?
Can I just repeat what I said about the RBA for RBNZ? It's a very similar story, I think. You know, they are looking at inflation and thinking, okay, it's still too high, but they are, you know, concerned about, you know, going too far. It's you know, a very basic situation when you are in a tightening cycle and you have moved aggressively on policy rates. You know, you're at this sort of inflection point where you're not sure if you need to push harder or whether you've done enough to get inflation down. You know, having gone on hot, you know, having left rates unchanged last month, you know, maybe that's a signal that they think they can pause for a while. And so I haven't seen what the consensus forecast is for next week, but I wouldn't be surprised if, you know, they go on hold again and just try and give themselves some time to see if what they've done will do the job without having to go further. So I think right across the region, that's you know where we're at the moment. We're in a sort of holding pattern. You know, the central banks across the region have done the work in terms of increasing policy rates, you know, pretty aggressively right across the region, and now they're just waiting to see if that does the trick.
Okay, one last question I'll ask you on the Kiwi side of things. That's looking at the labour market. I read that the participation rate now has been increasing quite rapidly, and it's at a record high. Now, I presume that's clearly helping to, you know, prevent the unemployment rate from going down too far. But presumably that in itself, you can't rely upon that indefinitely, which I guess is one reason why I'm kind of wondering if you know, the labour market is still tight enough that it might ultimately force the RBNZ, you know, to hike interest rates, even if perhaps they don't want to, due to what's going on elsewhere in the economy.
No, I mean that is very striking and interesting, just how strong participation has been going, and yeah, that's clearly a sign that the labour market is very strong, and that's going to feed into it. And again, that's very similar in Australia. Our participation rate here is pretty close, if not pretty close to record levels.
Okay, I know we got an RBI, Reserve Bank of India, meeting on Thursday. So them and anything else you'd like to talk about?
Yeah, so India is interesting in that you know, that they seem to be in a better spot. Definitely in terms of the activity numbers have been pretty positive. The PMI numbers are sort of weighing quite a bit north of 50, so that's good. And so they seem to be going okay at the moment. And that, of course, gives them a little bit more flexibility to adjust policy if they do feel inflation is not behaving itself properly. Again, inflation there though has come off a little bit, and I think they'd be reasonably happy with how things are going there. But we are coming yeah, I mean, if you look at the start of the year, it was around 6.5%. It's down now, 4.5% to 5%. So they'll be happy about the drop in inflation that's happened over the last few months. So they've got a little bit of policy room, I think, to either pause, or if they do feel the need to tighten a little bit further, they could probably do that just with the way that the activity numbers are going. Also bear in mind, though, that we are, that the inflation numbers are going to be impacted by, potentially rainfall patterns during the monsoon season, and the impact that has on food prices. So what you tend to find is the RBI does try and look through any sort of month-to-month volatility inflation that's caused by adverse weather effects.
Okay, brilliant. Thanks for all that, Brian. Let's round off then with my part of the world in Europe. Eurozone, well, unlike New Zealand, it's not actually in recession yet, but it's still much more of a recession candidate, and certainly some countries anyway. Second quarter Eurozone GDP we had a little while ago. That was up 0.3% in the quarter, which is stronger than expected. But within that, Germany was only flat. And that was after contractions in both the fourth quarter of last year and the first quarter of this year, so already in technical recession. Italy was down 0.3%, although France surprised on the upside with a rise of 0.5%. All of that was attributable to net exports. So pull that little lot together, it really means that domestic demand across the Eurozone is still soft, and indeed, if anything, probably slowing further. So could there be a recession in the Eurozone second half of this year? Well, certainly at least one negative quarter of growth wouldn't surprise me. All that said, ECB, well, to all intents and purposes, they appear to be ignoring the slowdown currently. Indeed, I guess it's almost certainly welcoming the reduction in growth, as it's perhaps a necessary evil in order to get inflation back to target. A couple of weeks ago, we saw the European Central Bank tighten by another 25 basis points, which was in line with expectations. That put the deposit rate up at a record 3.5%. In terms of where we go from here, well, it's still, as ever, very much data dependent, as with so many other central banks. But for what it's worth, you're trying to look at some of the nuances in the statement. It did indicate that they've shifted from this so-called determination to bring rates back to levels necessary to achieve their inflation targets, to set rates. It's only a subtle nuance, but it perhaps intimates that we have more members on the governing council now believing that interest rates are pretty well where they need to be in order to achieve the desired effect on prices. Certainly doesn't mean that we won't see rates going up again when we get into the next meeting on the 14th of September. But bottom line, of course, is you can almost ignore the real economy data and just concentrate upon the inflation figures. As we currently stand, we saw a mixed report for July with a headline rate down, but some of the core rates actually either holding firm or going down just slightly. And importantly, the services side prices there remaining very sticky, and indeed service sector inflation, which the ECB is concentrating upon particularly at the moment, that actually accelerated. Bottom line then, I guess that we could see a recession in the Eurozone over the course of coming quarters, but don't necessarily expect that to prevent further interest rate hikes unless we see a further deceleration in both headline and, more importantly, the core inflation data over the next few quarters. In terms of the next one upcoming, we'll get the flash HICP, their inflation report. That's due out on August the 31st for August, and that'll be instrumental in terms of what they decide to do in September. We can say much the same sort of thing about the UK and the Bank of England too, really, although it's got to be said that the economic outlook for the UK is even more clouded than most other countries, and that was very much highlighted in last week's Bank of England decisions. So the bank hiked interest rates, a bit like the ECB, again by a further 25 basis points up to 5.25%. But the vote was some 6-3. Now, within that, we've got the main dove, Swati Dhingra, who voted yet again for no change. 6 going for with the majority for an increase of 25 basis points, but a couple of members, Jonathan Haskell and Catherine Mann, two of the main hawks on the MPC, voting for a 50 basis point hike. So we got a 50 basis point spread across what the MPC members thought was the appropriate stance for policy, which really simply underlines just the high level of uncertainty that the bank's facing at the moment. For what it's worth, though, I guess you got to say that the kind of the bias on the interest rate vote suggests that we could still see another interest rate hike once we get into the September meeting. And certainly the bank acknowledged that inflation risks, as far as current issues are concerned at the moment, remain on the upside. Also got some new monetary policy economic forecasts out from the bank last week. Not that they matter much. They've been revised, and I guess the credibility of these now has diminished so much over the course of the last couple of years or so that not many investors are actually paying much attention to them. And indeed, just of note, it may be worth pointing out that the former Fed boss, Dr. Ben Bernanke, he'll be leading review into the BOE's forecasting methods to see how they managed to get it quite as badly wrong as they did. Let me round off from my side then just quickly with Switzerland, where the yield curve is negative, albeit not strongly so. By and large, the Swiss economy has actually held up relatively well in recent quarters. First quarter GDP was up 0.3 on the quarter, which may not seem to be overly strong, but by Swiss standards, that's still a pretty decent number. But it's worthwhile keeping on some of the Swiss figures over the course of the next month or so. Some of the leading indicators have been particularly soft. They're not always a great leading indicator of the hard data when it comes down to it, but nonetheless, they do suggest that we could potentially see quite a sharp slowdown during the second half of this year, and particularly with the Swiss franc close to levels against the dollar that we haven't seen since the central bank pulled the plug on its foreign exchange rate target back in 2015. It could well be both an economy and a currency to keep an eye on. Okay, then. Well, that's it, I guess, for this week. Fair to say that central bankers, investors, and financial markets in general are still grappling with how the global economy will shape up over coming months and quarters. So, as we always say at the end of these podcasts, make sure you stay focused on the data. And to do that, and indeed check out all the other key market moving events, do stay tuned to Econoday's Economic Global Calendar. On behalf of Terry, Max, Bram, and me, thanks as ever for listening, and we hope to see you again next time. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your Econoday Investors Journal now at shop.econoday.com.